On today's hot sheet, I'm discussing how China could crush the US housing market. A lot of news about China over the last 18 hours. We'll discuss how they could impact the housing market right here. Also, the March FOMC meeting minutes have been released, as well as the CPI report for March, just released this morning. The data there is encouraging. And weekly unemployment data. Today is Thursday, April 10th, 2025. I am Byron Lazine, and the hot sheet starts now. Live from Naples, welcome into the hot sheet. Let me know in the live chat which market you may be tuning in from, wherever you may be today. All right, we've got a lot to cover. It's CPI day. How well did shelter do in this huge CPI report here? Only, hours after the biggest news of, the year when it comes to the economy with what happened yesterday. I've been saying it for weeks. If you've been listening, if you have been following the hot sheet, I know I see a bunch in the chat. Many of you have been. Tariffs are like a light switch. I've been saying this over and over again. We had like months of people talking about what Trump tariffs may or may not look like. And a lot of people, negotiation tool. And then when they happened, it seemed that everybody on X, all the stock boys, all of the political partisans on both sides, political hacks, kind of forgot that. They kind of like went into a doom loop of fear. They forgot what the real reason tariffs were going to be utilized for. A light switch, turn them on, turn them off, turn them on, turn them off. They were turned off on almost every country except one. The lights are bright right now on China, but every other country they were turned off. Stock market saw its biggest gain since one-day gain, that is, since 2008. That's a long time ago. I went bankrupt on December 31st of 2008 after the mortgage crisis. Man, that's so far in my rearview mirror, it's not even funny. That is a long, long time ago. 2008 biggest one-day gain. I hope instead of crying, a lot of the stock boys chose to cry online. A lot of people were crying the last few days. I decided to buy. Okay. I saw the tweet or the truth yesterday. I had already bought when President Trump went and I guess you could call it manipulated the markets, if you want to, and say, go buy, good time to buy. And then a couple hours later, made the decision to pause these tariffs for 90 days on 75 plus countries. And we saw what happened with stocks. They went up. We already had the test run. And we mentioned this yesterday, like we already saw the test run. You know, you get a little bit of good news out there. What happens to stocks? They were so volatile going up and down. You knew at the minute there was any good negotiating news, these things were going to rip. I mean, just yesterday when I saw Zillow go down to $57 in the morning, I bought a little more Zillow. What'd they close at yesterday? $66, a quick $10 a share, 13, 14, 15%, whatever it was in like 3 hours. And I mean, nobody knew that the, probably Congress knew, Congress shouldn't be day trading. I'm sure a bunch of whole members in Congress, I saw an AOC tweet just ripping people, the activity a couple hours before obviously the announcement was made. And she's like, can't wait till May to kind of undress all these members of Congress who were trading an hour or 2 hours before the Trump announcement. I'm with you on that, AOC. I hope she follows through on that on both sides of the aisle, of course. But like, it was such an obvious time to kind of take advantage of this. All right. Stock market ripped. We knew it was going to rip eventually. Everyone that believed tariffs were going to be just put into place one day and be there for the next 10 years. That was a ludicrous. People go into these fearful, like worst case scenarios all of the time. Obviously not the case. So let's take a look now on why was this decision made really quick. Well, a Trump economic advisor says that the bond market, what we care about here on the hot sheet, the 10-year treasuries, added a little more urgency to the decision. Okay. Remember, the administration, Scott Bessent, the Secretary of Treasury, who's getting a lot of kudos from both sides of the aisle right now, lifelong Democrat, now serving in the Trump administration, Secretary Treasury Bessent, he's been saying in every interview he's done, does a great long form interview, really helps people understand kind of what these plans are, is that the administration values the 10-year moving down more than the stock market. They want to see the 10-year down. They want 30-year fixed mortgage go down. That's going to be a win for saying, hey, homes are more affordable if the 30-year fixed goes down. Some areas, yes. Low inventory areas, maybe not so much. But they want to go out there and say Main Street's got more access to capital, lower interest rate. They want the 10-year to move down, put pressure on the Fed, or do the job of the Fed without the Fed coming in and doing their job. Well, that didn't happen these last couple of days. We're going to get into why maybe that isn't happening here in just a second. But this 10-year actually going the opposite direction of where it had gone initially. Initially, with the tariffs went down to 3.9. It's like, whoa, look at this. This is beautiful. Yesterday's 30-year fixed mortgage was 7%. Moments in time for buyers is so critical. We've seen it for 3 years straight now. Since April of 2022, when they started raising rates, you have 0.5 point swings all the time on the 30-year fixed rate. Yet I'm going to wait for the rate. We're back at starting point 0, 7% today on the 30-year fixed. All the good momentum on the 30-year fixed wiped out because the 10-year became elevated. The opposite of what tariffs and this reconfiguring of the global trade markets was supposed to do. Okay. Remember, Bessent was really touting the 10-year as a win for the administration in those couple days where it was 3.9 and where it was 4. Okay. They want the 10-year to go lower. I do too. It impacts the 30-year fixed. Didn't happen these last couple days. And so the NEC director, Kevin Hassett, says the 10% universal baseline tariff rate is likely to stay in place for most countries because they're going to negotiate. They're talking about 75 countries are willing to negotiate. The reason, they dropped these down, the 10% universal baseline for the 75 plus countries, is because they didn't retaliate when the tariff was put on them. That's the administration's memo. That's what they're going with. It's going to take some kind of extraordinary deal for the president to go below the 10%. So they're going to be making deals over these next 90 days. But what got him to do this was, according to the administration, the White House advisors claimed this was always the strategy, moving down to this 10%, suggesting that the past week of massive tariffs that triggered the huge market losses was all for show. The market losses are essentially back. And we're up 135% in the last 5 years. So going down 12% wasn't necessarily the end of the world as we know it, especially when we printed 80% of our currency in the last 5 years. I can't wrap my mind around people losing their minds over 12% of money that shouldn't even be yours. It's fake money. But that's what we do. So the one country that retaliated was China. Okay. 84% reciprocal tariff on the U.S. The U.S. said for everybody, and you can go back and watch clips. I don't know, Haley, if you want to find a Scott Bessent clip, I'll play it. Scott Bessent, Secretary of Treasury, a week ago said when they put the tariffs on, if you don't retaliate, you'll be in good position. He said it clear as day a week ago, which kind of backs up this theory that I guess not theory, but the strategy that the White House is claiming that was always the case. White House claiming, hey, for the whole time we were going to see who didn't retaliate. China did retaliate. They showed what side of this thing they're on, according to the U.S. government. But all the countries that don't retaliate, we're going to know who we can work with. We're going to create win-win deals, better deals than what was previously in place for the U.S., but a win-win deal for both. And everyone that doesn't retaliate, they're going to be taken care of. Scott Bessent said that. You can, and if Haley can find the clip, here you go. Let's see if this might be the clip, but let's take a look.
Are you preparing to negotiate with some of these trading partners before that tariff rate comes into effect on April 9th?
Well, I think there have been a lot of discussions, but I think we're just going to have to wait and see what would happen. What I would say, Anne-Marie, is I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number. And I think the market could have certainty that this is the number barring retaliation. So we've got a ceiling, and then we can see
Haley,
if there's a different floor.
So you sound like you're ready for negotiation.
Scroll down. That is, that's a different post, but I'm familiar with the clip. That is, I'm just looking for the timestamp on that, but there you go. April 3rd. Today's April 10th. That's 7 days ago. That's exactly a week ago. You can drop that off, Haley. Treasury Secretary, give him a listen. This isn't a political thing. I'd give him a listen. He's a pretty fascinating guy in long form context, an hour or so. He's done a couple of these sit downs. But he said it a week ago multiple times, if you don't retaliate. And so that backs up the strategy of, hey, this was all part of the plan. They see who retaliated. It was China. They're going to have, whatever is going to happen here with China is going to happen, and they're going to work it out with the rest of these countries. Market reacts yesterday, highest day in a single day since 2008, went on an absolute spree. Any good news for Wall Street, and they go on these binges. Like they went to an all-you-can-eat buffet, and now the Dow's puking up 800 points this morning, because it's like, I don't want to eat breakfast after I just went and ate, 57 king crab legs at the buffet last night. I'm not really feeling breakfast. They're puking a little bit of it back up here this morning, as expected with the shopping spree that went on last night. But this pressure, they're saying it wasn't the pressure. Maybe you don't believe them, but Scott Bessent's comments would obviously lead to it being part of the strategy. Now, the bonds maybe move that timeline. The Treasury, the 10-year Treasury moving up the last couple of days, maybe moved that timeline up a little bit, maybe moved it faster. Why? One theory that's being pointed out there is the 10-year moving up when we were living in all of that uncertainty. Usually the uncertainty brings the 10-year down, as it did initially on the tariff. Well, one of the theories out there, and here's how China could crush the U.S. housing market, is at the end of January, foreign countries owned 1.32 trillion of U.S. mortgage-backed securities, 15% of the total outstanding. The other thing they own a lot of it is the 10-year treasuries. Okay, if China wanted to hit us hard, they could unload treasuries. Okay. And so one of the theories going on right now out there is that China is doing just that. They're unloading some of their, some of the debt that they hold. Now, somebody has to be willing to buy that debt, right? They have to have buyers. So China can't sell enough of this. Like they can't sell out unless they want to completely cripple their economy. They can't sell out all of the debt that they're holding. So it's ludicrous to think that China can completely, but they can have an impact where, oh, you wanted 4% on the 10-year, not so fast. Okay. Here's that number that I just mentioned. The U.S. owns 2.2 trillion on mortgage-backed securities. The Fed holds 2.2 trillion. So not all U.S. ownership, but just the Fed, 2.2 trillion. 1.3 trillion is foreign nations. Okay, so that's a little bit over a third of mortgage-backed securities is foreign nations, China being the biggest holder of that. So that's one way, foreign countries can kind of, and particularly right now, the only one you're looking at really, is China, because they were left out. The light was left on, the tariff light left on for them, light off for all of these other countries. Okay, here's another theory, or similar theory is basically what we're talking about here: China dumping the U.S. Treasuries to try to move rates and shift the narrative. But what Chamath Palihapitiya says here is China can't sell indefinitely. No, they can't. They can't sell indefinitely, or they're going to completely crater and crush their economy. So, this could impact, obviously, mortgage rates. China can have an impact on mortgage rates. Probably not something you're going into the living room on the listing pitch talking about, hey, China can impact the mortgage rates. Let's go ahead and sell now, because I don't think it's actually going to impact them, all that much. They could unload treasuries. It puts them in a precarious position just as much as it might put us. So does China now, the ball's in kind of their court, do they want to kind of create a man-made global recession based on what they do? Okay. They haven't shown economically to be, wearing the suicide vest or something like that. I haven't really seen that out of China. So not expecting them to do that. Here's that 1.32 trillion number. China already began selling off some U.S. mortgage-backed securities last year, with the country's holding at the end down to 8.7% year over year and down 20% start of December. So they've been selling these off. One of the reasons keeping this 10-year higher than we'd all like to see it, and certainly than what the current administration is. I don't buy too much stock in that because, again, they can't sell enough of that to make an impact where, unless they want to create their own economy. All right, let's get into the minutes here, and then we're going to get into the new CPI data. New CPI data is fascinating. FOMC minutes released from last Fed meeting. Last Fed meeting was about 45, 50 days ago, something like that. The current prediction for the next, according to CME Group, in 27 days, the next Fed meeting, we're back to an 80% chance that they don't make a cut on the next meeting. That's prediction. This was 50-50 yesterday before the tariff announcement. So basically, this tariff pause at 10% has bailed out the Fed. Now CME Group says, the Fed 27 days, they're not going to do anything again. They're going to continue to wait and see, kind of like they did when they wait and saw what happened with inflation when it wasn't transitory. They waited too long. Hopefully they don't wait too long here this time. But these Fed minutes show that there is some debate happening right now in the FOMC, the Fed committee, on the balance sheet runoff slowdown. So Federal Reserve's decision to dramatically slow the pace of its balance sheet drawdown last month was supported by nearly all participants in the two-day meeting, but several participants did not see a compelling case for such a move. Okay. This is according to these minutes that were just released this morning. The decision followed a briefing by the New York Fed System Open Account Manager, which laid out the case for slowing the runoff while there was uncertainty over how Congress would raise the federal debt ceiling. This is talking about central bank said it would lower the cap on how many Treasury secretaries it would allow to run off from the previous $25 billion per month to $5 billion as of this month, while preserving the $35 billion cap on mortgage bond drawdown. It has already struggled to meet. If they draw that down too quickly, that could, what we were just talking about there with China, that could swing some of that leverage over to China. The deceleration is what's called quantitative tightening, or QT, which has been widely expected. So that's the biggest takeaway probably from the minutes. Other takeaways, which are available in the show notes for all BAMX members, You have access to all of the show notes, how we put this show together every single day, and it's how we kind of bake the cake here on the hot sheet. You have access to that. Some of the other takeaways there was the long-term strategy for QT. Jerome Powell's justification suggested that the lower pace of QT could become the new normal, extending the process and preventing abrupt liquidity shocks. Like we saw abruptness over the last week that puts a lot of tears onto the internet, metaphorical tears. President John Williams supported the gradual approach, arguing that it coming in at a slower speed allows better data collection and prevents unnecessary disruptions. The Fed's balance sheet, ultimately, we don't want all this volatility, especially the volatility we saw in the last week. We don't want the volatility because it freezes decisions. Okay. Business decisions, whether that be hiring or investing, decisions from consumers, right? We saw that more so than anything when the rates have been going up the last 3 years. It freezes a decision to sell the house and go buy a new one. The inventory constraints have frozen up some sellers to make a decision to put their house on the market, right? We want a return to normalcy so that decisions can be free flowing, so that the market can be free flowing. Balance sheet reduction so far. Balance sheet has shrunk from $9 trillion peak in 22 to 6.8 trillion. So that is where we're at right now in terms of the minutes. I've pulled, and it's in your hot sheet show notes for BAMX members. I did pull all of the mentions of housing. The BAM team rather did, from these minutes. The minutes are, it's a 30 something page PDF. But we have, I'll give you the exact pages. How many pages is this thing? 18 pages, 18 page PDF. Out of the 18 page PDF of the minutes cover their entire 2-day meeting. There was only 5 mentions of housing in the entire thing. Remember, the Fed could care less about the housing market. They only care about 2 things: maximum employment and price stability, or getting inflation down to the 2% target, another way to say it. But there was 5 mentions of housing. Page 6, paragraph 3, borrowing housing costs for household, businesses, and municipalities declined. So talking about that 30-year fix moving down, we're starting back at ground zero here on the 30-year fix today. After yesterday's reading coming in at 7%. So this is a little bit outdated, obviously, from what's transpired the last 24 or 48 hours. Credit continued to be easily available for high credit score mortgage borrowers, and mortgage credit available for lower credit score borrowers continued to tighten. Okay. So when they say it's easily available for high credit score mortgage borrowers, yeah, if you're a high credit score mortgage borrower, you can get a mortgage. It's 10 times harder to qualify for a mortgage today than it was back in the mortgage crisis. And there's not all this, these ninja loans and that kind of stuff going on. And it's extremely hard for lower credit borrowers to, be approved for that mortgage. So, 2 things just to note there on that one. Page 7, credit continued to be easily available for high credit score mortgage borrowers once again. Then the follow-up to that is the short-term delinquency rate on the FHA mortgage inched down in January, but remained elevated relative to the past few years. So we're talking about some of these increases that you see on delinquency rates. They are obviously, but the past few years, a little bit elevated because you didn't have any of it going on, obviously, during the COVID years. But they're very low in comparison to, historical numbers. Major subcategories of prices, housing, service inflations continue to moderate. We're about to look at the CPI here now with the data that came out this morning on where it is. And there were a couple participants that did highlighted factors that might limit the inflationary effects of tariffs. Those obviously now seem to be short-lived after yesterday's news. All right, let's get into the CPI data. This news here amongst the best of the week. Obviously, yesterday's news impacting the rates, or not an impact on the rates, but impacting the stock market was great news. This is just as good news. Given any other week with nothing else going on, this would be the biggest news of the week. Inflation was expected on CPI report to increase 0.1% for the March numbers. Inflation for March came in at negative 0.1%. It was supposed to be here. It's a 0.2% swing. This is the best numbers we've seen since 2001 on the core inflation number. Shelter. Okay. Usually shelter, we look for shelter. This first, this is a 37-page PDF. Every month when we look at this on the hot sheet, we look at where shelter is usually the first line. The index for all items, or the index for shelter was the biggest driver. It'll say here, the index for shelter usually was the biggest, riser. Okay. Not the case. One of the first times I've seen this in years, probably since 2001, that shelter isn't kind of the main point from the Bureau of Labor Statistics on this report. The index for energy fell 2.4% in March. Energy, that's another thing the administration says is going to bring down cost of everything, is energy going down. So their plan is working there on energy. 6.3% decline in gasoline, more than offsets the increases for index in electricity and natural gas. The food index, in contrast, was a big riser, 0.4% in March, and 0.5% food away from home. Also some of the big risers. This all led to a 0.1% versus expectation, 0.1% to the decline versus expectation of a 0.1% going up. Look at this. Look at this 12-month change in CPI. Okay. Unbelievable. Core CPI comes in at 2.8%, 2.4% for headline CPI. And this was the biggest move here on core CPI, 2.8%, since 2001. All right, going to shelter. We'll go down here to our shelter numbers. Here they are, page 13 of the report, which will be available for you inside of BAMX if you want to grab it. Look at this. Shelter number comes in at 0.2, okay, for the month. If we look at the last 3 months, 0.3, 0.4, 0.3. So shelter overall, making up 35% of the CPI report, moves down to 0.2%. Rent of shelter comes in at 0.2%. Lodging away from home down 3.5%. Motel lodging down 4.3%. Other lodging away, so Airbnb. Yeah, you're seeing lodging away. Travel is softening up for sure right now. Maybe an indicator of just extra money for the economy. The owner's equivalent rent of residence comes at 0.4 after 0.3 last month, still 4.4 annually. But shelter, by the way, at 4, coming in as lowest number at 2001 as well. So overall shelter, owner's equivalent rent, which is a stupid category anyways, still a little bit elevated here this month, certainly being the case. 0.4% this past month versus 0.3 the month prior. And shelter, finally, not the main driver, though, in a current month for CPI inflation report. Obviously, the PCE still is the Fed's preferred measure. CPI is kind of what the markets care about. It's like maybe the markets knew yesterday that we're going to have good CPI, and then you had that announcement, for all of those gains to be kind of dumped in yesterday. I think they just ate too much at the buffet yesterday, and that's why you're seeing a little bit of a correction here today. If you look at all items coming in at 2.4%, energy again down, and this is a 12-month percentage change on energy. This is a win for the administration, who said energy is going to bring a lot of these prices down. A lot of inflation, home price, all these, they point towards energy as part of their plan, whether you agree with that or not. That is part of their plan moving forward, and they're seeing it happen here in real time. All right, so inflation easing 2.4% in March, lower than expected 2.8% on the core inflation number, which excludes food and energy. And here's your overall look at inflation before we move on from this, right? That less food and energy 2.8 and 2.4, lowest numbers we've seen on a look back all the way going to 2001. So great news there on inflation. We'll see if some of these if there are any tariff impacts. Obviously, the high tariffs on China are going to impact inflation next month. Maybe it could be short-lived. If there is, that's obviously a wait and see. We don't have to wait and see for unemployment numbers here this week. They're out. They're flat. They're moving sideways. Initial claims 223,000. It's an increase of 4,000 from the previous week's unrevised level. But inflation or unemployment rather not causing a huge concern right now. Biggest thing that I'm not concerned about, but just not a fan of, is this number, the 10-year Treasury, now back at 4.312. It's cooled off a little bit after yesterday, and with it initially dropped down here on the tariff news, and then it's kind of back up to where it was before the tariff news. We're not at a 6-month high. We're we're not at a three-month low either, because we had that low point of the tariffs. But if you take that out, that initial tariff decline, then we're kind of back at our 3-month low, 4.3. We're not over 4.5. So if you want to look at it glass half full, that's one way to look at it. Hopefully we get a little bit of a decline on the 30-year fix. It ended the day at 6.95. There was 2 readings yesterday. It came in at 7 and then 6.95. I mean, I like the Walmart pricing of 6.95 better than the 7 that they initially, Mortgage News Daily, reported yesterday. But this is a 7% rate, however you want to slice it. It's well off of where we were looking at 6.5 just 4 readings ago. And so kind of starting back here at ground zero, maybe we can start inching our way back to 6 3/4 today. I don't think we get there with this current 10-year, but I would expect it maybe to move down a little bit today, and I'm hopeful that that will be the case. All right, BAMFest, register. It will be on less than 2 weeks from today. Now BAMFest.com. We have a surprise guest, never been on a public-facing real estate stage before. Has been asked many times, this guest that we have coming in, and you do not want to miss it. I promise you. You do not want to miss it. Somebody from outside the real estate industry is going to be joining us there. We have Jimmy Burgess, Veronica Figueroa, as well as myself and Eric and Sharon are going to, all 3 of us going to be doing some moderating here on this event. Now BAMFest and all of our virtual events of the year have entertainment involved in our events. These are unlike any other virtual events. If you haven't attended one of them yet, make sure BAMFest is the first one you attend. Now BAMFest.com to get access to all of the show notes from this show, as well as all of your done-for-you content drops every single Friday. If you haven't been posting on social and you're like, I need to start posting on social, make sure you jump into BAMX and grab the drops that we have every single Friday. So you just go to the classroom for new this week. We'll be having a new drop tomorrow. And when you click these links here at the top, that gives you the entire scroll and hyper local content so that you can name the place, date, time, the cost, change the photo, all that kind of stuff. It's all available for you. When you click that link, you can download that and customize those. Have the directions on the how-to right below each and every single one. This is last week's drop. Huge drop. So many. Here's another template, obviously, that you can use with the scroll. There'll be some masters stuff, content here for tomorrow's drop for the weekend, and all of that available right inside here, as well as meme templates that the broke agent personally designs for you. Video scripts, email scripts, and blogging scripts with the source, the subject, the body of the email, the CTA, all built in for you inside of the new this week content. You also get all of the hot sheet data, all of the slides each and every single day, including today's slides, and including all of the hot sheet show notes as well, all in one place. That's over at school.com/BAMX, school.com/BAMX at our BAMFest event. Prices will be moving up. If you get in today, you're grandfathered on your price, as our current members are grandfathered for life. School.com/BAMX to get in. That's your hot sheet for today. There'll be a walkthrough pod up later on in the day on this channel. Tomorrow over on our Knowledge Brokers podcast, myself, Tom Toole, Lisa Chinati are going to be welcomed by Gary Ashton, #1 Remax team worldwide. Looking forward to chat up all things going on in our housing market and the industry with Gary tomorrow, Knowledge Brokers podcast. So tune into that as well. All right. Until next time, of course, have a great day. Toodaloo.